Markets do stuff you don't expect all the time. This is why it's always very difficult to get mired into one view or the other. Just pay attention to what the markets are doing. Here's what you need to know before the bell this morning. Markets had a really good day yesterday, and again, as we talked about, last week, this week can do pretty much anything because, there's nobody around trading, and you could have a big sell-off day, you could have a big up day, and again, it just kind of depends on, kind of what the inmates are doing in the asylum. Yesterday was a good up day. We're pushing into 3 standard deviation now above the 50-day moving average. So again, it's not like a huge major bear flag, anything like that. It just says that markets are a bit overbought here. And normally when you do this, you can certainly push further into that area. But typically you tend to get some type of pullback, to the 20-day, the 50-day moving average, etc. Well, right now the markets move so quickly that there's a fairly big gap between the 50 and the 20-day moving average, which are sitting right on top of each other. Now, the good news is the 20-day moving average is about to cross above the 50. So that'll be a kind of a good bullish support for markets, and particularly if we get a pullback, that's going to give you that support for that year-end rally. So again, as we kind of have been talking about here recently, just keep a watch on kind of what's going on. We're getting set up now kind of for this year-end push, but markets are going to have to take a little bit of a breather here of some sort. And again, not big, not major, but again, this is why we've talked about, taking some profits here, holding a bit of extra cash. Markets have gotten, kind of advanced here. Again, we're very overbought on a short-term basis. Our money flow indicator is about to flip over negative. So again, that's another kind of indication that you're likely going to have at least a short-term kind of market peak. And again, this doesn't mean the markets are going to decline by 10% from here. We've already done that. We had that 10% decline from the June peak to the October lows. This is going to be something like 2 or 3%, 1%, not big, just enough to pull you back towards this support line at the 50-day moving average that then gives you the ability to have that setup for that year-end rally. Now, where that year-end rally takes us is a different story. There's certainly expectations that we may be moving into a brand new bull market heading into next year. Maybe. I don't know. In order for that to happen, we're going to have to break out above kind of the January 2022 highs, and that's still a bit of a ways away. We haven't got there yet. Again, as we get ready to wrap up this year, we'll now have 2 years where the market has not made a new high. So we've done a long kind of stretch here where the markets have just been kind of consolidating over the last couple of years. But again, in the short term, we're starting to get pretty elevated on most of our signals, which suggests that this kind of overbought condition is going to give you a better opportunity to add to your equity side of your portfolio. Again, at the moment, absolutely nothing to be worried about. Now, again, headlines are a different story. Lots of concerns moving into next year. And again, yesterday is a good example. Saw the LEI index, the leading economic index, has been negative for 17, 18 months in a row now. A very long stretch, longest stretch of negative readings for the leading economic index since the financial crisis, yet we don't have a recession yet. See, and that's the big question as we head into next year. Will we, won't we? That's going to be the question. That's going to be the defining moment for this market, is whether or not we have a recession. It's easy to get into the camp that says, absolutely, we're going to have a recession next year. It's possible we won't. So again, this is why we just kind of keep harping on this over and over again. Be careful with where you're trading. Be careful with where you're taking on risk. And you can take on risk by not being in the markets, right? Because if the markets run up and away from you, you've risked money by not participating. So again, this risk comes in all different types of forms. So make sure you understand the risk that you're taking, risk of missed opportunities, risk of too much weight in equities, risk of not enough weight in bonds or too much weight in bonds. Those are all risks that we have to measure and calculate in our portfolio every single day. That's the challenge of investing. That's what you need to know before the bell this morning.